It gives me a great pleasure to welcome all of you to this conference. This is the 8th conference we organize, which exceptionally this year is held in December and virtually. And this is a conference that has been growing has grown significantly, has been going from strength to strength, providing a very stimulating forum for dissemination of research and engagement. As David mentioned, we have a very packed program and a very interesting one, I believe, covering a broad range of aspects, from VAT compliance to the role of nudging in tax compliance, to the role of disruptive technologies in tax administration, to getting the priorities right in tax administration, legal aspects, and of course, I should mention that we have 3 lectures from 3 exceptional keynote speakers from academia and the policy world. Professor Judy Friedman, who's going to speak today, Professor James Alm, who's going to speak tomorrow, and Mr. František Imres, who's going to speak the day on Thursday. I'm really looking forward to these lectures. At the same, but also, we have, as you might have seen in the program, later on today, there will be a special event, to celebrate Linode's achievements in academia and her contribution to the center. So please do join us, if you can, later on. Now, I would like also, David alluded, of course, to the in the Journal of Tax Administration that we publish, in the center, and I would like to take this opportunity, to announce that following the event, we're going to be publishing a special issue with the papers that will be presented at the conference, in the Journal of Tax Administration in JOTA. The special issue, of course, will be subject to the standard reviewing process of the journal. There will be a further announcement at the end of the proceedings on Thursday, and there will be no more information at the website of the center regarding the submission details and the whole process. But no, please do make a note and do consider submitting your contribution to the special issue. Let me thank you again for participating. I wish you a very enjoyable, productive, and stimulating conference. And of course, I hope next year, we'll be meet here in Exeter in the beautiful campus. Thank you very much. Now, I'm going to be chairing the morning session. The first, as you can see, the program has 5 papers. And the first presentation is going to be by Mazhar Waseem, University of Manchester, who is going to talk on overclaimed refunds, undeclared sales and invoice mills, nature and extent of non-compliance in a value-added tax. Mazhar, we're going to make you a co-host now, so you can share the slides. And I'm doing that now. Okay, you're a co-host now, Mazhar. Thank you for joining us.
So thank you, Christos and other organizers, for giving me the opportunity and inviting me to this conference. So really grateful and happy to be with colleagues. So hopefully you will be able to see my screen. Yeah, thank you. So this paper is about VAT non-compliance in an emerging economy. So VAT has seen phenomenal expansion in recent decades, And this expansion in large part has been driven by the belief that VAT, among the class of production efficient tax instruments, VAT perhaps has the best enforcement properties. So recently, however, a few cracks have begun to appear in this consensus. Malaysia, for example, has abandoned its VAT for a kind of turnover tax, and Zambia came quite close to doing so 2 years back. So the discontent from VAT, which by the way is not limited to these two countries, stems from two known sources. So the first one is whatever forces of self-enforcement are built into a VAT, so they break down at the last production stage where sales to final consumer takes place. And from that point backwards, the tax has the tendency to unravel. It has the potential to unravel. So second is VAT almost as a principle is operated as a destination-based tax, which necessitates repayment of any tax collected on exports. So the negative liability of exports and refund payments, so this is especially problematic in countries where the administrative capacity of the revenue authority is weak. So this payment of refund creates all sorts of issues for the tax administration, and it's known as Achilles heel of VAT in developing country setting. It exposes VAT to the types of frauds which are not witnessed, for example, in other instruments such as income tax. So we know theoretical mechanisms underlying VAT non-compliance, and we know almost since the start. So it's like not a new discovery. But my sense is we still, however, we do not have like a full grip on how important they are empirically. So that's where this paper comes in. So I exploit a tax reform from Pakistan. So where the VAT rate on 5 major supply chains of the country was reduced from 15% to 0%, to study to estimate the magnitude, but also the mechanism driving non-compliance of VAT in a representative emerging economy. So broad idea behind the paper, tax rate goes to 0. There is no benefit of tax evasion. But to the extent that tax evasion is costly, so then it's optimal for the profit maximizing firms to report something which is close to their true sales, to activity, true sales or purchases. And so then putting some structure on the problem, so you can back out the amount of evasion of VAT as it existed at the baseline in these industries. And this is what I do, and you are going to see the details in a bit. So as you know, that VAT can be evaded both by over-reporting sales, under-reporting sales and over-reporting purchases. But to claim input tax adjustment or input tax credit on VAT, so you need to have like a VAT invoice. So over-reporting purchases thus leads to a demand of VAT paper in the economy. And to fulfill this demand, so sometimes these fraudulent enterprises appear, so which have been named invoice mills by Keenan Smith. So these enterprises, they do not engage in any real business activity. So they only sell and buy VAT invoices. So they buy VAT invoices from firms whose real sellers do not need these invoices, because either they are unregistered or they want to like eliminate paper trail to them. And they sell these invoices to the firms who want to over-report purchases, and we can see how this process pans out. So one contribution of the paper is to document how these invoice mills work and how much VAT evasion is routed through them. Okay, so this is preview of result. So if we are in a world where there is no cheating, so where firms, they report truthfully. So in that world, if the tax rate reduces from 15% to 0%, so this tax cut should have no effect on firm behavior other than maybe stimulating real business activity, either through the demand channel because the price has gone down, or through the supply channel because firms' liquidity costs have gone down. So if there is no cheating, we should observe some increase in reported activity by firms in these industries. But what we observe is polar opposite of this. Reported activity in these industry goes down, and it goes down by a lot. So the elasticities implied by these responses, not only are they of opposite sign, they're very large in magnitude. So this shows that this behavior which I unearthed to this tax cut, so this can only be reconciled by the presence of large misreporting at the baseline. And using that using these responses, we can convert that misreporting into a number. And that number will be the amount of tax evasion which was there at the baseline. And what I find is that the evasion, it reduced the effective VAT rate at the baseline by nearly 3 percentage points. So that is quantitatively what evasion is. Qualitatively, what important result is, so in VAT we say that, okay, so tax evasion will be there, but it will be there towards the later stages of the production chain because of this last mile problem. Because in the later stages of the production chain, so this information trails, because they do not exist, because sales are to consumers who have no incentive to take VAT invoice. So then there is no paper trail from the consumer to firm. So everyone accepts that VAT non-compliance will be serious at the later production stages. But people make an argument that in firm to firm transactions, because there is exchange of paper and recording of transactions at two places, and there are information trails, so evasion will be lower at upstream production stages where transactions are between firm to firms. But what I find is that though it is right that evasion is stronger in the later production stages, but it is significantly, substantially higher and runs deep inside the supply chain. So in a developing country setting, so it's not only the final mile problem. So it's not the later production stages which engage in evasion, but it's to some extent happens throughout the supply chain. And these invoice mills, so they are an important conduit, so through which this VAT evasion takes place, particularly all the export related refund, which is overclaimed. So 40% of that overclaimed refund is based on the fraudulent invoices issued by these firms. Okay, so briefly, so the theory behind this paper. So consider this vertical supply chain. So each firm has 3 types of sales. Some of their sales is exported out of the country, and because exports are zero rated due to destination-based supply chain, so the tax liability on exports is negative. It's negative because there is no tax on output, but whatever you pay on input, that is refunded to you. So then some sales, each firm makes some sales to final consumer and some to the next production stage. So so sales of a firm have to be divided into these 3 groups because incentives to cheat are different on these different sales. For example, you want to like over-report your exports because there is a negative tax liability. You want to under-report your sales to final consumers, and it's quite easy doing this because there is no paper trail coming from this side. And you want to like under-report your sales of intermediates to the next production stage, but it's like harder because this firm would not like you to like under-report their sales and hence reduce their input tax credit. So this you can over-report only if you are in collusion with the next firm. So where both keep this transaction out of books. So you have to divide this sales of a firm into 3. So then there are certain purchases. And based upon this is the tax liability of a firm. So tau times this is output tax and tau times the taxable purchases. So that is input tax. Output tax minus input tax is VAT liability of a firm. You sum it over all firms. So this is the total revenue that government gets by implementing a VAT. So this is when there is no evasion. When there is evasion, so these are the reported quantity, and obviously you have incentives to over-report exports, under-report your sales, and over-report purchases. Okay. So then the amount of evasion is basically this. This is the total revenue. This is the reported. This is the revenue in the first buzzword when there is no cheating. This is revenue with cheating. You take away this from this. So this is the evaded amount. So if you can estimate this equation, you can estimate the amount of evasion in the economy. But the problem is that you observe this quantity because this is reported sales and this is reported cost, but you do not observe these true values. Okay. And here this quasi experiment comes in. So if you believe that at a tax rate of 0, so when the tax rate is 0, firm has no incentive to over-report or misreport its sales or purchases, and they approach their true values. So then you can proxy these unobserved true sales and purchases by the post-reform values. So then evasion in a certain variable can be like proxied by the reform-driven changes in these variables. So I observe these variables and I also observe how they change when the tax rate goes to 0. So then that allows me to like estimate these 3 terms separately, and then I can estimate the total evasion in the economy, and I can also look at the mechanisms that underlie it. What about like invoice mills? To give you the idea behind invoice mills or how they operate. So consider this like consider this this supply chain, which I'm showing only the last 2 stages of. So this is the firm which sells alpha of it, a proportion alpha of its output to an exporter, and rest of it to a retailer. Okay. So now imagine that this firm is not registered. So this is not in the VAT net. So this happens in developing countries a lot because a lot of firms, they are informal, they are small, unregistered firms. So if this firm is not registered, it's not in the VAT net. So then it cannot pass on the VAT collected at the preceding production stages to last stage. Okay. So whatever VAT has been paid here, so these 2 firms, so they cannot claim it as input tax credit because their immediate buyer is not in the VAT chain. So this creates incentives for invoice mills to appear. So then invoice mill will appear and they will place themselves in this rung of the supply chain. What they will do, they will buy invoices from this stage and they will sell it to them. And this firm will be happy selling invoices to this firm because their real buyer is not in the VAT chain. So they do not need a VAT invoice. So they would rather have that they could cut this paper trail. So they will be happy if the paper is issued in this firm's name. So in this way, so whatever VAT is collected here, this is passed on to these stages. But notice also that this firm has, because this is a retail firm, so they do not have any incentive to buy VAT invoice. So if they buy a VAT invoice, they create a paper trail of their purchases. And because there is no paper trail on this side, because they are making final sales to consumer, so if they can cut this paper trail, they can keep the whole transaction out of it. If they buy an invoice, they have to at least pay tax on the amount of value added on this transaction. So because of these incentives, so most of the invoices, they will be sold to exporters, because exporters, so whatever purchases they report, 2 times that purchases is refunded to them. So that is their refund. So they would like to over report purchases, but this firm has no incentive to buy VAT invoice. So invoice mills, so therefore always combines, always engages in this divergent fraud. So this divergent fraud is input tax utilized in domestic consumption is routed towards exports to overclaim refunds. Okay, so this is the conceptual background. So reform I have already told you about. So this reduced the tax rate from 15% to 0%. So this reform is novel in the sense that not only the output produced by these industries was zero rated, but also their major inputs were zero rated. For example, if you look at the textile supply chain, so obviously the textile output like shirts, bedsheet, everything was zero rated. Tax rate was reduced, but but their inputs were also reduced to zero. For example, cotton, polyester, colors, dyes, everything. So then essentially what they did was they took these supply chains out of the VAT, reducing their liability on both exports and both output and input to zero. Okay. So what I do is I simply compare the outcomes in zero rated industries to other industries, and I run the conventional test to show that this empirical framework is valid. So let me show you the results. So this is the first stage. So this is input tax reported by firms. So red are treated industries, so blue are non-treated industries. So you see here the reform took place. So the tax rate goes to zero here, and the input tax reported by the treated industries goes down by a lot. So this is not surprising, because input tax is tax rate times taxable purchases, and because tax rate goes to zero, so then this is unsurprising that so this input tax goes to zero. So some of it is mechanical effect because the tax rate has gone to zero. The other is behavioral effect, that is there is change in reported purchases. And I'm showing this only to show that the reform created large tax rate variation between the two types of industries. Similarly, you can look at output tax, and you can convert this into difference in differences framework. And these are pure behavioral responses. As I told you, so the tax cut occurs at this place. So when tax rate goes to zero, if anything, activity here should be stimulated and this should go up. But what I observe is this goes down immediately and it stays down. And there's this large gulf appear between these two. So this shows that these purchases, they were being over-reported at the baseline. And when the incentives disappeared, then the firm reported something close to their true values. And similarly, you can look at sales. So sales also dropped, but they dropped with a time lag. And my sense is this time lag appeared because when you have been over-reporting purchases, so you will have large unsold inventory in your books. And before you can get rid of that inventory, so the sales will not return to the true equilibrium.
Mazhar, you have 5 minutes. Thank you.
So then putting, as I said, putting some structure onto this problem, so you can convert this into numbers, how much evasion there was at the baseline, and you can convert into effective tax rate. So nearly 3%. So evasion amounted to 3% effective tax rate on sales of these firms. And you want to also break down this evasion into how much of this results because of this destination-based design of VAT. So which means how much of this results from overclaiming of refunds. And because I observe, so by how much exports were reported, then using this production function of exports, I can convert into by how much the purchases used for exports were overreported. And using that, I can estimate the overclaim of refund. Okay. And this is the result. I won't go into details of this, but this is the result on that evasion is not limited to later stages, but it runs deep into like the supply chain. So I can, because I observe firms in the supply chain, so then I can look how it varies across the supply chain. And what I get is that this goes deep. Okay. In the last few minutes, so these are invoice mills. So tax cut happens here. So if you have like forward-looking firms, forward-looking profit maximizing firm, so when tax rate goes to 0, so there will be some intertemporal shifting of activity, but that activity should be shifted to this side because the tax rate is 0 here. But what we observe is that there is concentration of activity, but this is on the opposite side. So this shows that these invoice mills, so they are pumping so this VAT paper into the system while it is still standard rated, so that their buyer firms, they can claim refunds on it. And using two sources of data, so this blue curve is amount of refund claimed by exporter on the invoices of blacklisted firms, and this red curve is the total volume of invoices of invoice mills. So these two curves are from two different data sources, but they track each other very well. So this shows that most of the sales, reported sales of the invoice mills is towards exporters. So they are being used to like, so this print as money printers, so getting the money back from the government. Okay. So how can you identify invoice mills? So what I find is that unless you act early, so their distinguishing markers of invoice mills are their early sales, which means their first 6 months sales, and other activity is really large. So these are run and hit firms. So they register, so they report a lot of activity in first 6 months and then they disappear. So unless the tax administration has capacity and can track them early, if you lose them early, so then their other characteristics, they're not too different from other firms. So that's why like in tax administrations with weak administrative capacity, so these invoice mills, they will be like problematic. So they will be not easy to distinguish. So I'm almost running out of time. So to conclude, what I do in this paper is I use a large tax cut, so which reduced the VAT rate to 0 on 5 major supply chains of the country, to estimate the amount of evasion as it exists in the economy. And what I find is like a substantial amount of VAT gets evaded. It reduces the effective tax rate by nearly 3 percentage points. And it runs deep into the supply chain and the invoice mills. So they are an important conduit through which this overclaim of refund takes place. So now I stop and look forward to your questions.
Thank you. Thank you very much, Mazhar. Fascinating work. I'm looking at the chat room, waiting for people to ask questions. And while they, people are thinking, let me ask a couple of possibly clarifying questions. The first one is, you mentioned the deepness in the supply chain. The evasion runs quite deep in the supply. Do you have a sense of that? Can you measure that? How deep that deepness is? That's number one. Secondly, you mentioned that most evasion takes place within the supply chain and not at the end. Is it a peculiarity of the Pakistani invoicing system? Because I guess what I'm thinking of is if you think about in the European countries, I mean, there's quite significant. And I'm thinking about I guess the Southern Europe mostly. Okay, there's significant. I mean, the governments are thinking about incentivizing people to kind of ask for a receipt when they purchase. And that's precisely the idea, because then you get compliance across the chain. If you incentivize people to ask receipts, then the business will have the incentive to purchase invoices themselves. So I didn't quite get why you think that at the end of the supply chain there's no much evasion. And the other thing I wanted to ask is, do you have any sense about sectoral evasion? Which sectors are most prone to engage in these evasion activities in Pakistan? Thank you.
Yeah, thanks a lot. So in the later stages of the supply chain, because there is sales to final consumer, and they do not have any incentive to ask for invoice or receipt unless the government runs some scheme creating these incentives. So then there is no paper trail, and the firm can report whatever they want because there is no paper running from the other side. But in farm-to-farm transactions, if this firm underreports their sale, what happens is this firm's sales of intermediates is purchases of intermediates of this firm. If this firm underreports their sale, the input tax credit of this firm goes down. So then they won't like it. So this is like asymmetry of cheating incentives, which people say that this reduces tax evasion deep inside the supply chain where there are farm-to-farm transactions. But you see, if both firms, if they collude and if they keep this transaction out of books, so surplus in that case is higher. It is higher because if this firm can also if this firm can also underreport their sales in turn, so then they will not be required to pay value added on this. So then if they can collude, so then it's in their interest to keep it out of business. So what I'm finding out is in developing countries, so these collusions, so they are pretty easy to so these collusions take place routinely. And so there is evasion runs deep into the supply chain. I think probably you misunderstood me. So I did not say that evasion. So what I said was the evasion is stronger in the later stages of the supply chain, but it runs deep. For example, because in tax, so here what I'm doing is I'm looking only on the supply chain of textiles. I have divided this into different production stages. And what I find is in the first production stage, so there is almost no response. But as I move to the second production stage, which is entirely farm-to-farm transactions, so then evasion appears and it's quite strong. So this shows me that this collusion between farms, so this is not so difficult. So when you are in a developing economy.
Thank you. And there was another question about sectors. And I guess just go back to the collusion. I guess I mean it is a developing country, of course, but I guess when you talk about collusion, I mean that would depend upon the length of the chain, because each business to business then will have to collude with the other. I mean there should be multiple collusion within a chain. So, and I guess in a possibly not in the context you are looking at, but in another context where the paper trail works a little bit better, you would expect that you get as the chain of production is quite long, the collusion is more difficult to be achieved.
Yes, so theoretically, so these mechanisms, so they make a lot of sense.
Yeah.
So, but when you look empirically, so my sense is like, so this has to be looked at empirically as well. So I do not find like any evidence that this is really a strong consideration when firms are evading.
Mm. And in terms of sectoral evasion, do you have any evidence?
So I have only like 5 sectors so where the tax cut was reduced to 0. So then I can like directly observe tax evasion in these 5 sectors.
Mm-hmm.
And there is no difference in
there's no difference
across the sector. So there is almost the same. So I cannot like project it to other sectors without making like strong assumptions. So which I do not do.
Thank you. Very, very interesting. Thank you. I don't see any questions coming through the chat room. There's one. Do you see it, Mazhar, or shall I read it out? Okay.
So just sharing Indonesia's experience with regards to invoice bills, tax office generally is able to significantly reduce the magnitude of such evasion by using automatic invoice matching mechanisms and massive law enforcement effort. So you might want to consider putting this in model. So my sense is like there is 2 types of evasion. So one is like double-sided evasion. So double-sided evasion is where both firms, they do not report a transaction. So then there could also be like one-sided evasion. One-sided evasion is that this firm, so they over-report their purchases on their own without in collusion with this firm. So if you have one-sided evasion, so then cross-matching is really useful, and cross-matching of sales and purchase transaction level data. So that is going to cut down one-sided evasion. But my sense is a lot of this is 2-sided evasion. So where both firms are in collusion, so they report the same thing in their sales and purchase records. For example, if whatever is the sales record of these firms, it matches purchase record of this firm, and purchase record of this firm matches the sales record of this firm. So then the government cannot detect an invoice bill by a simple cross-matching of transaction level data. So you have to do something more. And my sense is that these are not, so at least in the Pakistan's case, so these are not discovered early. So I have like another set of results where I look at, so when are they discovered? So they are discovered quite late. And by the time they are discovered, they have already done the damage. Because what I show here is that most of their activity is in the first 6 months. So if you catch them early, so if you tag them at the registration stage, that this is like a suspect firm, I need to watch them, and you look at their early behavior, and you catch them within 6 months, then it's okay. If you do not catch them within 6 months, then they have already done the damage, and it's already too late.
Thank you. And on that note, let me thank you again for a wonderful presentation and stimulating discussion. Thank you. Thank you, Mazhar.
Thanks a lot.
Thank you. Next, we have Thiess Buettner from the University of Nuremberg, speaking on income tax deductibility of services to combat VAT evasion. There are quite a few papers now on evasion. There's thesis, and then there's going to be another one at 12 o'clock on VAT fraud. So please stay tuned. Fascinating topic. Thiess, all right. Welcome. The floor is yours. 20 minutes plus discussion. Thank you for joining us.
Yeah, it's great to be with you. Although that's an online format, so it's less fun than other times. But anyway, please stop me when I sort of take too much time. Can you see my slides?
Yes, absolutely.
Good.
Go ahead. Thank you.
So Actually, this paper just follows up on some of the issues Mazhar has mentioned already. So it's talked about a specific instrument to combat VAT evasion on the last mile. And it's joint work with Bojana Mazarova. She's with us in the audience, and Orlando Zadach. We are all based in Nuremberg, Germany. So what's the topic? I mean, we've heard this before. So VAT is celebrated for its self-enforcement mechanism. The point is, along the value chain, for all business-to-business transactions, you have buyer and seller reporting transactions, which sort of facilitates enforcement. However, we have this problem that Mazhar characterizes being the last mile. If it comes to the business to the final sale, business to consumer, only the seller reports. And this raises then the issue what to do. It's a common issue with many sales taxes, but in this case, since VAT is such an important revenue instrument, we've seen some discussion about what to do. Basically, what you might do to combat this type of non-compliance is moving to cashless economy, perhaps. Perhaps that's in the future. It might never come. We will see. Perhaps also problems actually increasing. So if you do transactions with digital currencies, it might be even more difficult to tackle fraud. What's been discussed in the literature is tax lotteries, where sometimes consumers can participate in a lottery, and this gives them incentive to collect bills. And this way, this reporting by the consumer might be induced. The EU, where the VAT is very important and where the VAT is actually being regulated heavily at supranational level, we have seen various attempts kind of surrender to the problem by allowing countries to have reduced rates on household-related services. So, and the idea here is just reducing the incentive, but of course, at the same time, giving up on a lot of revenues and perhaps also creating distortions. Another way to solve these issues is perhaps to use what you might consider being a tax systems approach that tries to use in the tax system somewhere other instruments like subsidies that provide an incentive for the consumer to collect bills and perhaps even report. And actually, Germany did this some time ago and introduced an income tax rebate for the consumption of household services. So when you do your income tax declaration, you can report the amount of household-related services that you bought over the year, and you can a certain fraction of these expenses are just deducted from your income tax payments. So if you've already paid to taxes like payroll taxes or whatever, you get a rebate. And this is not depending on your marginal income tax rate because it's just a rebate from the taxes paid. So we study this in this paper using a unique source of data, which is a VAT panel, and we provide micro-level evidence. We discuss and come up with a specific identification approach. The results are that we do see that treated firms show an increase of sales by about 13 percentage points. This, in a way, is expected, even if the measure is totally ineffective in combating non-compliance, because, in a way, it's a subsidy. You make certain services cheaper, and that might boost demand. But we also deal with a second indicator, and the second indicator shows us that output VAT actually increased relative to claimed input VAT by 8%. And from these two results, we can conclude that predominantly the additional sales come from shifting along the formal informal margin. It's still not completely finished, the paper. We need to see what finally the revenue effects are and how worth this type of intervention is in terms of revenues, but that's left for future analysis. So let me briefly talk about the subsidy. I don't think we need to do that. So there are specific rules in the German tax code which allow you to deduct expenses on household-related services. The policy changed over time, not so important for us. And it has been criticized a lot. So the German Court of Auditors was saying that this is one of the largest tax subsidies. It is reported in the annual subsidy report, and currently since 2013, the numbers amount to something like 2 billion euro in revenue losses every year. And so over time, this has amounted to quite some type of rebates. Here's a graph in German, unfortunately, that shows how many taxpayers are actually using this device. So what you see on the vertical axis is the number of taxpayers. I need to check. Some of the figures refer to the money, and some refer to the numbers of taxpayers claiming deductions. I think the left-hand side gives us the number of taxpayers claiming deductions, and you see here in the blue a line that it's about quite substantial millions of taxpayers are using this. And it has extended substantially in 2006, you see here, and that will be mainly the time period for our analysis where we look before and after 2006 in certain treated industries. So we thought a bit about how we can analyze those effects, and because it's a bit tricky that we have sort of a subsidy, but we also want to say something about compliance. So we come up with a simple model. So the idea is that a firm can provide formal services, F, or informal services, I. So the total production of the firm is X, and there's this choice, the channel of which it can be determined by which this comes to the consumer, either formally or informally. If it's formally sold, there's a price P. If it's informally sold, the service, then there is a price Q. And the firm's profit function is a combined profit function of formal sales and informal sales, and their wage cost to be deducted. And also input taxes can be deducted, and then there is remittances of the tax to the authorities. We introduce here this cost of tax evasion, which as standard in this type of literature is a convex function of the amount of evasion here, of the amount of informal sales. And you think through this sort of quite intuitively when you try to determine what is the optimal amount of informal provision of the service by the firm. This is reached when sort of the price differential between informal and formal sales just meet the marginal cost of tax evasion. And that's the equation 2 that you see here on the bottom of the slide. So that's the firm side. The consumer side, the demand side, is that we assume extremely simple that the consumer has the same utility from formal and informal sales. So they are perfect substitutes. The consumer's budget then includes the payments for the formal sales as well as the payment for the informal sales. And you see here that we introduced S already, which is the subsidy that we are going to analyze. Now, from the consumer perspective, the optimal amount of consumption, F and I, if there's an interior solution that the consumer buys both formal and informal, the requirement is that the price differential between formal and informal sales is zero. The idea is here that the compliance cost is shifted entirely to the firm. That might be changed, but it's just a simplifying assumption. Now we can put this together in a graph and determine in this graph the equilibrium amount of tax evasion. Okay, so on the vertical axis, the price of informal sales; on the horizontal axis, the amount of informal sales. We see sort of the supply of informal sales is a positively sloped line because of the cost of tax evasion, which by assumption is borne by the firm. And then the demand side, in a way, is the consumer that is willing to pay a certain amount of these informal sale for these certain price for these informal sales, and the price is equal to the gross of tax price for formal sales. Now, if you introduce a subsidy, what you do is you reduce the price for the good, and therefore the consumer is less willing to pay also for informal sales. And then quite neatly, you can show that the amount of optimal evasion or the optimal amount of informal sales goes down, or the equilibrium amount of informal sales goes down as a consequence of the subsidy. Now, what's important for this model, why we put up this model, is we want to discuss how we can relate this to our data. So we try to come up with some predictions. One prediction regards gross revenues. What is the elasticity of the subsidy on the revenues? And we see it depends on two margins here. One is the expansion of production by firms, and then the expansion of informal sales. Since informal sales decline with higher subsidies, it is sort of obvious, the prediction that total revenues will increase out of this subsidy. And this effect, however, even happens if there are no informal sales. So we come up with the second variable, second indicator that we can observe in our data, and that's gross revenues relative to input taxes. Okay, and if we do here the derivative, we find that this term is different. And if we get a positive elasticity on this tax ratio, we can only have that if there are informal sales, and this allows us to come up with some predictions. So what we do in the analysis is we determine this gross revenue effect and the tax ratio effect, and then we can deduct the two empirical effects, and what we get out of this is simply the demand expansion by the subsidy. And then we can compare the coefficients, and if the elasticity of gross revenues is equal to the elasticity of the tax ratio, then we would say there's no expansion of production. All additional revenues come from informal purchases shifted to formal purchases. And the opposite result would be that the tax ratio stays constant. In this case, all of the effect on additional revenues comes from the expansion of production, and then there are intermediate effects. Okay, and we looked this up in the data. So we use German VAT statistics, which is actually the universe of all VAT-paying firms. In our data set, which is a panel, we have 6 million firms, and we observe the time period between 2001 and 2011. Somewhere in the middle, we have this introduction of the subsidy, and we reduce the estimation sample a lot to remove issues. One is exporting firms. They have clients that don't get the subsidy. Then the subsidy appears mainly be important in the context where you have the standard VAT rate. So we drop all firms that report taxes at reduced rates. We dropped first and last years of a spell because new firms might have specific VAT payments. We dropped firms that switch industries, and we dropped firms that enter the data set in the year before the treatment. Basically, the regression is a diff and diff, where we look into our two indicators. We have two VAT performance indicator. One is total taxable sales, and the other is this output versus input taxes, this tax ratio. And we do a simply diff regression on a treatment and some dummy variables around, clustering of residuals, all like standard. Treatment, to identify treatment is extremely tough. So we went through the tax code and tried to identify out of a very fine 5-digit classification which industry is affected by the treatment, and so we identify this. We have a lot of trouble because the industry classification changes over time, and there are lots of details to get this going. The control group, we don't use the total rest of the economy as a control group because, I mean, in a way, these measures are very selective. And so what we do is we look into a control group that has equally high levels of illegal employment. And so we select non-treated sectors with similar characteristics as has been used in the literature in different contexts. And to do so, we use official publications about the extent of illegal employment in different industries. And so we end up with control sectors being meat industry, repair of motor vehicles, passenger and freight transportation, hairdressing, hotels, and restaurants. So in the end, we have a treatment group, we have a control group. The control group is less observations, perhaps, but that's important to have sort of similar firms there. We do some testing for pre-trends here for the one VAT performance indicator. Our estimation quite neatly follows a common trend assumption before treatment, and we see that there is a shift after treatment. There are lots of things going on. 2007 was a large VAT increase, many things going on. So it makes sense perhaps to have some not a flat development after the treatment, but the important point is here the difference. The same with the log ratio. Also here, the data support this common trend assumption. So coming to the results, if we just take simply an indicator whether an industry is treated or not, we get these kind of elasticities here. So when there's treatment, we see that sales of treated firms increase by about 11 percentage points. Also, the tax ratio increases, but a little less. But this is sort of, if we take all reforms, in the most important, so really the music of this experiment, of this quasi-experiment happens in 2006. So we are focusing then on a subsample of those industries that are really affected by the 2006 reform. And if we do so here in column 3 and 4, we again have these results for the sales and for the tax ratio. And what we see is elasticities are about of same magnitude. So sales go up by precisely 11, more precisely 11 log points, and the tax ratio goes up by 9 log points. So in a way, this seems to indicate that both indicators increase, and as they increase by the same amount, following our simple theory, we would say, well, all this additional sales come from shifting informal to formal sales. We have trouble with the data. It's really tough to work with them. We can only do remote processing. So we have to send in codes that are computed 2 weeks later. We get outputs, then there was a mistake. And so this is a very cumbersome process. And there are reporting problems. So the statistical offices made some problems when reverse charge was introduced, and so did some misreporting. We came up with an ad hoc fix. And if we put this in 5 and 6, however, our results are the qualitative result that the both dimensions are the same is confirmed. So then we look a little bit more deeper into different groups of industries, and we find that for tiny partnerships, although these are the most important fraction of our data and in the treated and control groups, we don't find significant effects. And if we exclude those tiny partnerships, we get the results as you see them here in column 3 and 4. Similarly, if we just focus on corporations, we get these results in 5 and 6. And so it seems to indicate that this really the equality of the coefficients only holds if we have tiny partnerships in, but the tiny partnerships itself don't show strong effects. And so it could be that the entry in, so that the threshold, the VAT reporting threshold that comes from that sales are only liable to tax if they exceed a certain threshold, this type of problem probably causes a lot of conflict in the data. So we think it's more reliable if we exclude these tiny partnerships. So from this, we would conclude currently that income tax subsidy boosted taxable sales by about 8 to 11 percentage points. VAT output to input taxes increased by about 8 to 9 percentage points, excluding these tiny partnerships. The effects turn out to be 13 and 8%. So this indicates that the increase in taxable sales is mostly driven by shifting from informal to formal sales. There still is a subsidy-based boost in sales, but this is of smaller magnitude. I think what we are going to do before we submit the paper now is trying to do some evaluation of the policy, how much in VAT revenue is gained from this shift, informal to formal, and how much is what is this in terms of revenues, and then we want to relate this, of course, to the total subsidy volume to check whether the whole program makes sense from an efficiency perspective. So thanks for your attention.
Thank you, Thiess. I didn't flag the 5-minute sign because I didn't want to interrupt you. You're kind of moving.
Oh, sorry, I didn't saw that.
No, that's fine, but it's very timely, so that's okay. We're still on target. Thank you. Very, very interesting. Very good paper as well. I'm looking at the chat box and I'm expecting questions to come through. Actually, you anticipated my question, which is the revenue yield, and I guess the answer is you don't know that yet.
Yeah, it's tough to answer. It's really tough to answer.
Okay.
Yeah, we have to do the analysis. COVID put us back in our time schedule.
I appreciate that. I mean, the other thing it came to mind while you were discussing that is, some other countries have done it differently. So some countries are kind of building the personal allowance, okay, by using these receipts. Has Germany done something similar? Is it the only policy they have tried? The one you discussed?
Yeah, I think so far it's the only type of subsidy that is provided in Germany. So they all put their faith in this kind of measure, and this measure was easy to was an easy measure to implement politically because it was heavily supported by the craftsmanship's organizations quite predictably. So that was easy to get through, and other attempts only worked in terms of a really enforcement in trying to detect illegal employment and stuff like this. However, there is no clear evaluation of different policies.
Yeah, no, thank you. I guess there are different incentives because one is out of taxes paid, and the other is you're building the threshold, your taxable, your personal allowance. So I guess there will be different incentives kicking in. Very interesting. I mean, there's a question in the chat box which says, "Do you know what percentage of the firms change industry?"
Yeah, I mean, basically, we would know. I could know. This is, of course, in the data. We noted that there is a problem. So in the end, we put this out, but the industry classification to some extent is more soft information because it has no immediate legal implications. So firms would just can send in a message to the statistical office saying that, you know, they changed their classification is different. Perhaps it's checked also, but it's soft information. So we think that most of the changes come from firms really changing their composition, fusions, or selling parts of the firm, that this is the major driver of these shifts. There are substantial in terms of total numbers, but as a fraction, probably small. My feeling would be it's in the 5% margin or something of firms changing their classification over the longer time period that we analyze.
Thank you, Thiess. There's another one which says, how important is the B2C VAT non-compliance compared to B2B collusion in Germany?
That's a good question. That's an excellent question. Actually, the B2B collusion in Germany is a major issue, but the government stopped to really produce hard data on it. We recently, a group of public finance scholars issued a report and sent it to the Minister of Finance that it's high time to provide better data on this. And that's still sort of scandalous that we don't know the amount of B2B collusion. What's mainly discussed is this type of carousel fraud that is an issue in Europe. Statistics on this have been produced many years ago. They stopped producing those, and they're extremely difficult because some of the fraud happens by disappearing firms, and some of these firms disappear because of bankruptcy. So you have to, in a way, distinguish bankruptcies from voluntary drops of firms, and that's a tough issue. And so we don't know. Friedrich Schneider, who is sort of the expert on the shadow economy, he would say that probably, typically he gives the feeling that the B2C is very important. And he says, okay, that this type of non-compliance is the tax rebellion of the small taxpayer. So there is this kind of view that B2C non-compliance is important, but what we don't know is how large is the B2B part, and that's a tough one.
Thank you. We're almost out of time, so let me thank you again, Thiess, for a wonderful presentation, and thank you for joining us. It's good to see you.
Good to be here. Thanks.
Thank you. So, moving on is going to be Duccio Gamannossi del Innocenti, who's gonna speak on, VAT thresholds without non-compliance.
Yeah, I'm here. Can you hear me?
Yes, we can, Duccio.
Nice.
Just give it a minute before you start. It's 29. Let's start on time.
Can you see my slide?
While you're getting ready. Yes, we can.
Nice.
Yes, we can. So, my clock says 1:30. So
okay.
Yeah, go ahead.
Let's start.
Thank you, Duccio.
So first of all, thanks for having me here today. Today I will present a joint paper with Christos, that I guess you all know, and with Konstantinos Serfes from Drexel University in the USA. The paper is about thresholds, and some of you might already have seen an earlier version of it at the latest TARC conference. Today I will give you the updated version that is not final, but close to it. My presentation is pretty standard. I will start by trying to provide you with why we have done this research project and what are our aims. I will then provide you some insights on the model that we have developed and illustrate the results that we have obtained through it. And finally, I will sum up what we have learned by doing this research exercise. So clearly, the importance of VAT threshold comes from the importance of value-added taxes. They are almost ubiquitous and account for a sizable part of the total revenues. We're talking about 20% of the revenues in developed countries, 4 to 5.5% of GDP in developing and developed country, respectively. A common feature of VAT system is the presence of a threshold on turnover, meaning that if a firm has a turnover above a given threshold, then it has to register. There is a high variation in threshold, even between countries that have a similar GDP per capita. Here you can see Cameroon and Pakistan, Germany and France. Using a threshold responds to several objectives. First, given that compliance costs are heavily impacting small firms relative to big ones, it could be that some part of the population of small firm is pushed out of the market by these costs. And so it might be welfare enhancing to exempt them from VAT registration. Also, from a point of view of efficiency in collection of the revenues, it might be a good idea to have a threshold, because administrative and compliance costs to collect the revenue might be higher than the revenue that is possible to get from small firms. And it is indeed true that most of VAT revenues comes from bigger firms. The problem is that having a threshold introduces distortion in firms' decision, in particular on the decision of firm size, with firms that might prefer to bunch below the threshold in order to avoid registration, and because it will introduce price and quantities distortion in inputs and outputs. We will have a close look about these effects in a while. Our paper fits in the VAT threshold literature, especially in the strand of this literature that investigates how VAT threshold impact on firm size and registration choice, and to a recent strand of literature that highlights how there is a spreading along the production chain of firm responses to VAT. There has been reported evidence of transmission of compliance, possibly driven by transaction sorting and the fact that firms do prefer to trade with firms with the same registration status. And there is also evidence of vertical integration induced by VAT, possibly to reduce the cost of collusion in order to perform evasion. Our paper belongs to the strand of optimal VAT threshold that has been started by the seminal paper by Keane and Mintz in 2004. They identify both revenue and welfare maximizing threshold, and their optimal threshold have been widely applied, but their model entail simplifying assumption that we are not entirely satisfied with. So in our paper, we try to study optimal VAT threshold in a richer modeling setting. The current shortcoming in the literature, in the Keane and Mintz paper, is related to the fact that the production chain is compressed into two layers, a competitive market and a final goods sector. This means that input and output prices have to be fixed, and so the only distortion that this kind of model is able to account for is the one induced on the size decision of the firm. So it is not possible to account for interdependence of registration choices, and it is not also possible to account for distortion in prices and quantity. So it is likely that the prescribed VAT threshold that is derived using this model is biased. So what we do, we try to build on the Almunia et al. Paper, and we set up a more realistic model of the economy. In our economy, we have from upstream to downstream 3 sectors, a competitive one, an intermediate goods sector, and a final goods sector. And we explicitly model then business to business and business to consumer links. Our prices are flexible, and there is also input intensity flexibility, so that firms with different registration status can trade differently with firms that have different registration status. More so, we have bunching that occurs in 2 sectors, and they are going to interact across the production chain. So what we are able to do is to have a model where we are both accounting for bunching distortion and price and quantity choices, as well as their propagation along the production chain. The research questions that we try to answer are basically the same that were answered by Keane and Mintz, but in a richer modeling setting. So what is the revenue maximizing threshold and what is the welfare maximizing threshold? I will just provide a glimpse on the model in graphical terms without equation, but my main aim is to show you what are the distortions that this model is able to account for. So as we've said, we have three sectors, a competitive, an intermediate, and a final one. The competitive sector is entirely registered with fixed prices, and we have flexibility in the prices in the intermediate and final goods sector that depends on two drivers: the productivity of the firm, and more productive firms and lower prices, and we are modeling productivities as Pareto distributed. And the other driver of the prices is the registration status. Clearly, if a firm is registered, then the price of the goods it's going to sell are going to embody the VAT, but it will be able to claim credits on inputs, and the opposite happens in the case of an unregistered firm. Here you can see what is the relationship between productivity and various measures for a firm in a setting without a threshold. So I'm gonna illustrate this graph in a clockwise fashion, starting at the top left panel. You can see that we have a lot of firms that have low productivity, and we have a fat tail of firms with higher productivity. When a firm is more productive, its prices is going to be lower, so its demand will be higher, and so the optimal firm goods production will be higher. And also the profits are going to increase with the firm's productivity. And in this setting, the turnover density is very similar to the productivity one and comes from the interaction among all the firms in all the sectors. Now let's consider what happens when we are introducing a threshold in this setting. The VAT threshold in UK, for example, is £85,000. We are used to think about it in terms of turnover, but for analytical objectives, it is better to refer to the productivity threshold. There is a mapping between the turnover threshold that we call SI and the productivity threshold that in the intermediate sector we call hi-hat. We have exactly the same relationship in the final sector with SF and the FAT. Now, when we are introducing a threshold, we have a discontinuity in tax liabilities and profits. Now, the firm has to pay taxes. And so some firms with productivity higher than the threshold would like to bunch at the threshold by mimicking the one that are there. They do so in our model by selling the same price and quantity of goods. And by doing so, they obtain higher profits than if they were to register, and also bigger profit than the true firms at the threshold because they are more productive. However, by doing so, they are distorting farther from the optimal behavior, and so much of the possible gains from productivity are wasted. And so we can identify another productivity threshold that we can call the bunching threshold, I hat plus BI in the intermediate sector, and the analogous in the final, such that above this level of productivity, it becomes again more profitable to register instead than bunching. So bunching is performed by the firms that have a productivity that is between the threshold of registration and this bunching threshold for both sectors. Now, in graphical terms, we can see what is happening here. So before the threshold of registration, everything is similar to what we had before. So when a productivity increases, so does the optimal firm's good production, its profits, and the distribution of productivity resemble the one of turnover. However, if we have a look at the incentive of the firm, so the profits, when it is crossing the registration threshold, we can see two lines. In the blue one, it is the profits that it would achieve if it were to register. In the black one, the one that it can obtain by bunching. As you can see, the registered one are lower than the bunching one, and the bunching behavior is nothing but continuing the production at the level of the threshold firm. By doing so, what happens to our distribution is the emergence of a gap, because all these firms will prefer to bunch, and so will result in a mass of probability at the threshold. As we were saying, the bunching distorts the behavior of the firm, and so their profits are raising less than what it is possible to achieve when behaving without distortion. And so at some point, in this case FAT plus BF, our bunching threshold, it becomes again more profitable to be registered. And so above this level, firms start again behaving optimally. And so we have a positive probability of observing firms above this turnover. So this is what is happening in our model when we are considering a single sector. And so this graph is what is our representation of what is happening in reality. Here you have a graph from Almuni et al. In the UK for 2019, and the red line refers to the normalized to the threshold turnover. And as you can see, there is excess mass before the threshold given by the firms that are bunching, and a gap in the mass of the firms above the threshold. Clearly, our representation is much starker because it comes from a simplified choice, but we are somewhat representing what is happening, and that is driven by economic reason. So now that I've presented what is a sector, let's see how the different sectors in our economy interact, so to understand what we are able to model with it. As I was saying, we have a competitive sector upstream, then we have an intermediate goods sector with a continuum of firm with lower productivity, high, lower hat, a continuum of firm in the final goods sector, and finally the consumer. When we are introducing a threshold, this leads to the emergence of a productivity threshold and a bunching one in both sectors. Now, just for illustrative purposes, I will refer to just three firms, three in the intermediate good firm, in the intermediate good sector, and three in the final good sector. Let's say that they have different productivity and so different registration status. All of the firms in the intermediate goods sector are going to buy from the competitive sector. And if we define, similar to before, final goods firm, we have that all of these firms in the final sector are going to buy from each of the firms in the intermediate goods sector. They will combine, the final firms will combine all the inputs from the intermediate in order to produce a good that is bought by the consumer. If you want an example, you can think about the competitive sector being selling milk, and the intermediate firms being a cheese producer, like brie, mozzarella, and feta, that is then sold to restaurants that prepare meals that is bought by all the consumers. Now, this way of modeling the economy allows us to account for distortion coming from a variety of sources. I will just give you an example here that clearly is not exhaustive, but hopefully will give you a hint of what is happening. So the competitive sector, as we have said, is entirely registered. And we will consider the case of a bunching firm in the intermediate firms, in the intermediate sector. This firm has an input distortion caused by the fact that it cannot credit the VAT, and an output distortion that is caused by indirect VAT effect. We will get to this in a second when I have explained the other distortion in the final sector. So this bunching firm is going to sell to registered firm, where the input distortion will be represented by the cascading of the distortion that they are inheriting from the bunching firm, and the registered firm is going to sell its good with a price that includes the tax, and so there will be a direct effect of VAT on price. the bunching firm in the intermediate will also sell to bunching firm in the final, with again an input distortion that consists in cascading, and with a price that it will be levied to consumer that is without tax, but reflects the fact that the firm is bunching and so is distorted. Furthermore, we have also an indirect VAT effect because the goods are complements, and so when there is distortion in what is bought from the registered firm due to the VAT in their price, there will be also distortion in the amount of goods sold by bunching firm. The case of non-registered firm is pretty similar to the bunching one, but without the bunching distortion. Now, all of these distortions are really going to affect the input that these firms are going to demand to the bunching firm in the intermediate sector, and this is our indirect VAT effect. So basically, this is the representation of the distortion in prices and quantity that we are able to account for. Everything is connected to everything, and so we are able to see how the distortion moves across the production chain. So now for the result, what we obtain is a model that is able to account for the interaction between registration incentives and also in bunching incentives. So we have that an increase in bunching or in registration in one sector is going to affect the bunching and registration in the other sector. And we are also able to replicate the sorting of trade that is observed in the empirical literature. Now, what we want to do is to provide some qualitative results, but still we want to try to match as best as possible reality. So what we do is to calibrate the model to the UK economy during 2004-2015. We have some exogenous parameter, and then we perform a calibration of the productivity distributions, so to match the empirical turnover. We minimize in particular the mean square error of the percentage of non-registered and bunching firms, the turnover at the threshold, and the turnover at the 19th quantile. You have our calibration result. We are a bit overshooting on the percentage of non-registered and bunching firms, but we are quite close with the turnovers. So about the revenues maximization, so the optimal threshold for revenue maximization, the optimal threshold will have to balance trade-off between administrative costs and distortions of tax base. We characterize analytically this optimal threshold in the simple case without bunching, and we do a numerical exercise to compute optimal threshold in the general case. We studied three settings. The first one that we use as a baseline, in which we try to come as close as possible to the Keen and Means case in our model, and then we consider the one that is more policy, a setting that is more policy-oriented, with the threshold that is the same in both sectors, as it is customary for several tax systems, and then the theoretical optimal one, where the threshold can be different across sectors. This is the table with our result. Here you have the optimal threshold for the intermediate sector and the final sector. In the Keen and Means case, it is 176,000. And in our case, where the thresholds are the same across the sectors, 90,000, and when they are different in the two sectors, we are talking about 85 and 110. So what we are showing is that the optimal threshold should be, in order to maximize revenues, should be lower than the one that can be computed when the production chain is not accounted for. So we are asking for a higher registration level, both in the intermediate and a final sector, even if these result in higher bunching. About the welfare maximization, I will just be brief. It would be a weighted sum of individuals' utility and net revenues. We haven't finished this part, but preliminary results just show that welfare maximizing threshold is higher than the revenue maximizing one, and this is somewhat intuitive, given that you would like to have a higher production that will deliver more income to the individuals.
Duccio, you need
so in conclusion,
you must wrap up.
Yeah. Okay. So just in this paper, we show that there are a lot of distortion that might be introduced by that threshold that are currently not accounted for in the literature. And when they are accounted for, we show that the optimal threshold comes up as lower than the one that is possible to obtain without taking them into account. So that's it.
Thank you, Duccio. Thank you. There are a couple of questions in the chat box. Do you see them, or shall I have them out?
Yeah, let me just close this thing. Okay. So more about the relationship between revenue and productivity. Taking them as synonyms is a crucial assumption you make, isn't it? Okay, so about that, they are not synonyms. They are just mapping one to the other. Let me just open again these slides and share again the screen. Okay. Okay, I'm gonna share again the screen. Sorry about that. Okay. Okay, so they are not synonyms. The productivity maps into the turnover, but they are not the same thing. And because from passing from productivity to turnover, you have all the interaction between firms. And you have, and this interaction depends on all the exogenous parameter and the endogenous one related to the registration status of the firms. So, for example, when we are introducing the threshold, you can see that, I mean, also by eye, but believe me, the relative sides of the firms that are registered between these between the productivity threshold and the turnover threshold is the same, but there is not a linear relationship between the turnover threshold and the productivity threshold. I don't know if this answered the question.
Well, Zara might come back on that. So, what do you move to the second one? By Mazhar.
Okay, let me just try to open. Can't really open the chat.
Yeah, it says what okay. Okay. Can you read it? Or
yeah, what incentives have to bunch below the registration step? Can they register involuntarily to eliminate the? Okay, yeah, that's a great point. That was answered by Almunia for the UK from the UK system again. We are not including these in our model. It would require for the intermediate firm to also be able to trade with the business with consumer. Basically, without that, we can do it, and maybe as an extension can be done, but it cannot be accounted for in the model as it is at the moment. But yeah, for sure, this is an important part, especially if you consider that there are a lot of voluntary registered firms in several systems.
There's another one.
The intermediate does not sell to consumer. Do you expect by adding this, the result will change? Yeah, for sure. I mean, they will change quantitatively for sure. For the qualitative, it's really hard to tell because we are talking about a major change to the model. So I'm not really sure about that. Sorry, I can't be more precise.
Thank you, Duccio. I guess the important thing to emphasize here is the interdependencies across the the supply chain. That if you play with one threshold, then something happens along the chain, and that changes the incentives. I guess that's the idea behind the paper.
Okay, so yes, I'm Angelos, and I'm going to speak about fraud detection in VAT networks. So you can see here the collaborators on this project, and these are their affiliations. So here is a small but necessary disclaimer, since we're working with some sensitive economic data provided by the Bulgarian National Revenue Agency. As the title implies, we're interested in detecting fraud in the value-added tax system. As the first paper implied, it is difficult to estimate, but there is a lower bound estimated, a lower bound for the losses in revenues due to fraud in the value-added tax system, which is about 50 billion euros. So the revenue authorities utilize already some algorithms, but by doing some work academically, we can help them to deal with big data and to improve their efficiency in detecting fraudulent activity. So in this project, we would like to utilize the structure of the VAT transactions and the risk behavior of the taxpayers in order to detect high-risk taxpayers with risk to be involved in a fraud scheme. So we will also like to perform an early detection of these risky taxpayers, and we would aim to build a general fraud detection tool that could be also utilized possibly outside the VAT context. So we focus here on the specific fraud, which is well known as missing trader intra-community fraud, which is a very well organized fraud across many sectors and countries. This fraud is due to the lag that is created between the importing date and the date where we import goods and the date where the taxpayers have to pay the corresponding VAT amount. So this time lag creates opportunity for fictitious trading. So several traders are exchanging goods, are making exports, imports, re-exports. But at some point, one trader known as the missing trader disappears. So the VAT is lost. The VAT that this trader had to pay is lost. So the authorities aim to detect this missing trader or any other traders, illegitimate traders that involved in a missing trader scheme very quickly, because they want to prevent a large amount of VAT to be lost. So here is a very simple figure about the missing trader scheme. So you can see that the missing trader imports the goods, take the goods from the importer, and then the goods are exchanged through some traders known as buffers. Then there is a broker that can export the goods and can reclaim back the VAT. This cycle can go for more than one time, so the VAT amount is bigger and bigger and bigger. But at some point, the missing trader will disappear and the VAT amount will go lost. So our idea here is to represent all these VAT transactions as a network where the nodes correspond to the taxpayers. The edges exist if between two taxpayers there is at least one VAT transaction, and the width of the edge represents the total amount of the VAT that has been exchanged between the taxpayers. So this is what the revenue authorities can see if they construct the network that corresponds to their data. But as I said, the missing trader and other fraud schemes create fictitious transactions, create illegal transactions. So we have some nodes that are illegal, we have some edges that are illegal, but the authorities cannot see these edges, can see only the blue edges here. So here we give what statistics and what machine learning can do about this and how it can help. So we define this problem as a network anomaly detection problem, as a statistical network anomaly detection problem, and we aim to provide a supervised learning algorithm in order to deal with large and complicated networks as those constructed by VAT transactions. And then we will be able to perform a graph-informed classification, binary classification between legitimate and non-legitimate taxpayers that involved in MTIC fraud. And we can thus detect some aberrant, some non-abnormal nodes, edges, and subgraphs in the observed network. So our main output will be taxpayer-specific fraud probabilities and groups of risky taxpayers. And given this output, then we can help the tax authorities to conduct targeted audits in order to prevent a missing trader scheme as early as possible and minimize the loss in revenues. So we have, in this application, we applied on data from Bulgaria, so we have access to all the VAT transactions conducted in Bulgaria for a given period of time. This network here depicts VAT transactions between sectors, economic sectors in Bulgaria. So each node corresponds to one economic sector. The edges again exist if we have transactions, VAT transactions between the nodes, between the sectors. And the width is again the total amount of the VAT exchange between two nodes. So this is already a complicated network. Here you can see the size of each sector here. This is already a complicated network, but we deal with even more complicated networks because we are interested in individual taxpayers. So our network is constructed from individual taxpayers. Each node corresponds to one taxpayer. So we have a large amount of nodes, large amount of edges, and much more complicated networks than this one here. But this is already a good example of the complexity of the problem. So our data consists of everything that has to do with VAT. We have all the VAT transactions within these categories here. We have all the forms, VAT returns submitted from the Bulgarian taxpayers. We have a large number of VAT registered taxpayers, which are more than 300,000 taxpayers. So we have a network with more than 300,000 nodes. Importantly, we have access to the information for the classification that the authorities have already conducted to the taxpayers as illegitimate or not, based on some criteria that they have or from past information about their activity in MTIC fraud. And 1% of the taxpayers are classified as highly risky. And we also have some access to firm-specific data like the size of the companies, the age of the businesses, the labor costs, and the sector that the company belongs. So as I said, our main idea is to represent all these monthly VAT returns or the monthly observations, VAT transactions, as weighted directed graphs with nodes that correspond to the taxpayers, with the edges that exist if we have one invoice between two taxpayers, and the weights are the sum of the VAT base in the sales invoices. A network can be represented by this matrix capital A here in bold, where the ij element of this matrix is 0 if we don't have any transaction between the ith and the jth taxpayer, and is wij if we have at least one transaction, and wij is the VAT amount, is the weight of the network. We also denote by capital Y the binary vector that indicates the taxpayers that have already classified as risky with respect to the MTIC fraud by the Bulgarian authorities. And our aim is to utilize this network structure and this binary vector in order to build an algorithm that can detect as early as possible the new risky taxpayers after the taxpayers submit their VAT return forms. So we applied our method in a specific period of time, which is from January 2016 to December 2017. We assumed, in order to test our method, we performed a type of out-of-sample exercise. So we assumed that we know that the risky taxpayers, the fraudsters, as configured up to November 2017 by the tax authorities. And we would like to predict, by using our method, the new configuration of this binary vector. So the new entries and the entries that continue to exist altogether for the next month, just after the taxpayers submit their return forms, the VAT return forms. So we propose to combine all this node taxpayer-specific information. Taxpayer and node for us is the same now, with a graph structure, with the structure of the transactions in order to identify our high-risky taxpayers. And we build an algorithm with main ingredients, the binary classification decision trees and the spectral decomposition of the observed graphs. So first, given all these graphs that we observe, these 24 in our application, we can extract some average characteristics for the taxpayers, for the nodes of the graph, which is the in and the average in and out degree of the graph, the strength of the nodes, the degrees of the nodes, sorry, the eigencentrality, the average eigencentralities of the nodes. And we can also construct this matrix X with rows as many as the taxpayers, which are capital N, with P features for each taxpayer. So each row in X corresponds to a taxpayer and is consistent, the ith row, from the number of transactions that the taxpayer has conducted within these categories. We have also marked some transactions that have been conducted with high-risk taxpayers. The ith row of the X matrix for us now contains also the information about the size of the companies, so the age, the VAT, the VAT age of the companies, the labor costs in the sectors of the companies. And we also include in the ith row of the X the averages characteristics that we have extracted from the observed graphs. And again, Y is our binary indicator that indicates risky taxpayers classified up to November 2017 from the authorities. So in our first step, we perform a binary classification by using logistic regression trees. So we are using this particular XGBoost algorithm, extreme gradient boosting, and we aim to feed this algorithm with our X information in order to predict taxpayer-specific probability. So this is the predicted fraud probability for the ith taxpayer. And by utilizing our binary indicator and the observed data, we can learn these functions F here, which are called trees, in order to have the minimum error, let's say prediction error, when we estimate the fraud probabilities. So this XGBoost method is very efficient. It's a very well-known now machine learning tool for conducting binary classification and other regression tasks. It's very fast and can scale well with the large dimensions that we have in our dataset, because as I said, we have almost 500,000 of taxpayers. So here is how the decision trees work in a very simple example, but I'm going to skip because I'm scared from the time. And if someone needs more details, we can happily discuss. And then we go to our second step of the proposed algorithm. We are having now, given the predicted probabilities for the taxpayers to be illegitimate, the taxpayer-specific probability, we want to combine with the structure of the graph these probabilities and extract and update these probabilities by borrowing information from the observed graphs. So our idea here is to construct what is called a Laplacian of the graph, and in particular, we construct a kind of risk-informed Laplacian, because here we construct this matrix here, tilde L of A, where this L of T here is the graph Laplacian, which is this tilde A here gives information about our observed graph, and we add this part here where we give the information, we feed to our Laplacian of the graph the information about the predicted probabilities. Here is the mathematical description of how we can define this Laplacian, this tilde L of A carefully. And having defined this matrix here, this risk-informed Laplacian, we would like to perform a spectral decomposition of this graph in order to understand its structure. So by doing the spectral decomposition, we obtain capital K eigenvectors and capital K eigenvalues, and we can compute for the ith taxpayer its kth loading. And when we plot these loadings, so here we plot the first 200 loadings for a subset of the taxpayers, a non-random subset. And you can see here, this line here indicates the fact that below the line we have all the taxpayers that have already been classified as risky from the authorities. So you can see that the risky taxpayers have a footprint here, because the loading in this position for these taxpayers is much higher than the loadings of the legitimate taxpayers. And we also will have in this position some taxpayers not identified as risky by the authorities, but with this same large value. So we would like to use this information and update now our probabilities that we estimated in our first step. So how we can do this? We can construct this matrix capital W with elements WIK, and then we can also construct a new binary indicator vector, which indicates the taxpayer as risky now, if was classified already as risky by the authorities, or if we have predict in our first step that the taxpayer is risky with a high probability, with a specified threshold. And then we can combine the binary indicator and the features, the graph features now that we obtained from our spectral decomposition of the graphs, in order to update our risk probabilities utilizing this graph information. And we use again this XGBoost method, which is very efficient in binary classification. So after doing all this algorithm for our dataset, we constructed these ROC curves in order to compare our classification with the classification obtained from some other classification methods. This symbol here is the one that we conduct in the first step without utilizing any graph information, while this autoregressive here means that we utilize some time lag information about the riskiness given from the authorities. So you can see that our line, our log curve in dotted green here is higher than the other log curves, so we have a more accurate classification. The first figure here corresponds to the log curves for the classifications of all the taxpayers that are risky in December 2017 and depicts how accurate we can detect them. These log curves here corresponds to the taxpayers that appeared as risky at first time in December 2017 as a first time. So they were not new as risky, but they came as risky only December 2017, and the authorities, they had classified them as legitimate up to that point. Again, we outperformed the competitors. And here we have a second evaluation of our method. With respect to the points, with respect to the number of taxpayers that we can report as illegitimate, because we cannot report all the taxpayers. We can find all if we report all, but due to practical constraints, only a small amount of taxpayers can be audited. And here we'll have again the true positive rates and the false positive rates from our classification and the competitive classifications. This is again for all the taxpayers in illegitimate taxpayers in December 2017, while here again we plotted the same thing, the true positive rate with respect to the number of taxpayers that we report to audit, but only for taxpayers that appeared as fraudsters for the first time in December 2017. Before I finish, I also mentioned this interesting byproduct of our algorithm, which is that by using a clustering algorithm known in the machine learning literature, we can identify clusters and subgraphs of taxpayers and of risky taxpayers with similar profiles. So if the authorities combine this with the probabilities, the predicted risk probabilities that our method outputs, they can investigate even better the connections and hidden connections within the complicated graphs of the strat. So this is the end, and we are dealing here with the complex missing trader intercommunic fraud as a network anomaly detection problem. We constructed a graph-informed supervised algorithm in order to detect aberrant vertices and some graphs. We have some evidence for more accurate detections of fraudsters compared with alternative methods. We can increase thus the tax authority's ability to deal with big data and to prevent loss of revenues. And here is some feature work that we would like to add in the project. And thank you very much for listening, I hope. Are you listening?
Thank you. Yeah, absolutely. No, thank you. Thank you, Angelos. Very interesting presentation. And if I can add, I mean, this is it's an outcome that is coming from a wonderful, cooperation, very productive cooperation, okay, with the tax authority. I see a few questions coming through, Angelos, in the chat box. Would you be able to read, or shall I read them out?
No, I can read. So it's Luca first, Luca Salvadori. So about the class. Okay. So how large the clusters are? Okay. So yes, Luca is asking for the number of clusters that we can identify with this byproduct feature of our data. This is a tunable feature of the method. So by asking for 200, let's say, eigenvectors and eigenvalues from the spectral decomposition, we can identify 200 clusters because each eigenvector corresponds to a cluster. And about the size of the clusters, this is again tunable because we have a constant here alpha that compromise between this constant between the risk probability and the graph structure. So we can identify either some very big clusters that contain all the risky taxpayers, or we can, let's say, make a separation of the risky clusters and put medium-sized clusters with risky taxpayers, and the legitimate taxpayers can be in very, very small clusters. And we have also, importantly, we have also identified a very, very, very big cluster, which contains the vast majority of the taxpayers, which are the legitimate taxpayers. So in summary, we have a very large cluster with the legitimate taxpayers. We have medium-sized clusters with risky taxpayers with similar characteristics, and we have small clusters, again, consisted of legitimate taxpayers. And then we have another question from Mazhar, who says, to what extent your algorithm depends upon the initial set of risky taxpayers identified by the revenue authority? It depends very much on that because it is a supervised algorithm. So without this information, we cannot apply this algorithm. But the results are not affected from the configuration given from the authorities because then we combine this configuration here that is inserted in this matrix, in this vector P, hat P, with the graph structure. So we are allowed to learn again our binary indicator by utilizing the loadings coming from the graph structure. I hope this answers the question.
Yeah, he might come back, Mazhar. So why don't you move on to the next?
Luca is also asking again, can you give some information on the revenue yield from detecting the non-compliant? Okay, the revenue yield from detecting the non-compliant business. Yes, this is thank you, Luca, again. This is kind of future work. So here, where I have that we need to evaluate our false positives, we also need to further collaborate with authorities, if possible, in order to obtain information about how much revenues are lost. But for this type of analysis, we haven't dealt with this issue.
I think the next one is also related to that. I think it clarifies at this point.
Yes, again, Lucas, those you have identified as fraudulent tax authority, do you know? Yes, clarifies, yes. So I hope I answered.
Yeah. Would you be able to comment on how applicable this method might be for other tax authorities? I guess at some point the code is going to be publicly available.
Yes, again,
this tax authorities can utilize.
this again another to-do thing that I would like to build the software that implements, underpins these methods. And the final aim is that will be a very general tool that can be freely available to tax authorities academically, let's say, in order to perform the classification. Because the method, as I also mentioned in the beginning, is a general method without any Bulgarian, let's say, assumptions. Not even VAT assumptions. Is a like type of more general fraud detection tool. So yes, it's possible to write a general software that can be released to the tax authorities worldwide.
And then I guess this is something that Mazhar alluded to. I mean, the better information you utilize, I mean, the more accurate the prediction is going to be. So I think it's going to be important for the tax authorities to build the right infrastructure in terms of
Sure.
Providing this data, and then pushing forward. I mean, I can see that as working on in real time. Okay, so to speak, as tax authorities get digitalized. Okay, so to speak, and information is coming through in real time. I guess that might be one way. Yeah. Okay. Any other questions from the participants? I don't see more questions coming through. I mean, we still have a couple of minutes left. Angelos, if you want to add to the discussion, that's okay. If not, then we can stop here. Thank you.
No worries. I'm free for everyone to ask anything that you want, either now or at the future point of the conference. And I'm here to enjoy.
Absolutely. Okay. Thank you very much. Thank you.
Thank you very much.
Thank you for joining us. Right. Okay. So next we go to Athiphat again. And again, my apologies for.
All right. See you again. Let me share my.
That's fine. We need a couple of minutes, okay, before we start.
Okay.
We're slightly. It's 26:12, so give it a couple of minutes and then we'll start. Thank you.
Okay. First of all, thank you for including us in this VAT session. This is my joint work with Mazhar Waseem and Songwood Burong at the Revenue Department of Thailand. We use the tax return to understand how Thai firms respond to the VAT threshold. Before I start, I just need to briefly state a disclaimer. The views expressed here are our own and do not represent those of the Revenue Department. So the VAT registration threshold, as discussed a lot by earlier papers, is one of the most common size-based tax regulation in many countries. Its main purpose is to simplify tax matters for small firms. It relieves them of obligations to charge VAT on consumers and to comply with all of the administrative requirements. But the threshold itself may have important impacts on firm behavior. Recent studies often find that small firms bunch sharply below the threshold. The threshold could also distort competition between firms inside and outside the VAT system. This underlies the role of the presence of non-VAT business, which is going to be our focus in this study. We used the de-identify panel of Thai tax returns to analyze three responses. First, bunching. Second, the voluntary registration decision. And the third one is the growth impacts. To preview our main results, we find that there is a clear bunching just below the threshold, and the presence of non-VAT business is strongly correlated with both the bunching pattern and the decision to register voluntarily in the system. We also present evidence suggesting that the threshold put a brake on the growth of small firms. Our paper is related to two strands of literature. The first one is the group of study that look at how firms respond to the registration notch. The second group looks at how tax interacts with informality. We complement to this literature by emphasizing the role of we call it VAT informality, which is the presence of a non-VAT business in the local economy. We also present evidence that small firms restrict their growth when they approach the threshold. So let me give you a brief background on the Thai VAT system. Similar to many developing countries, the VAT constitutes the largest source of tax revenue in the country, roughly a quarter in 2019. VAT registered firms also account for over 95% of all of the nation's corporate income tax revenue. It has been implemented since early 1990s, following the recommendation of the IMF, and the rate has been held at 7% since 1997. The VAT itself is very broad-based with very few exemptions or zero rating allowed. The registration threshold is set at approximately $60,000 US, and small firms with turnover below the threshold are exempt from the threshold. This threshold has been set at this level since 2005, and now it is still considered large relative to OECD and other Asian countries. We use the de-identified panel of VAT and corporate tax return data for the population of Thai firms from 2012 to 2017. These two types of tax return are linked. So we have information on VAT registration status, financial, and some demographic variables. We follow a methodology by Cleven and Waseem's 2013 paper. We measure bunching by comparing the actual distribution to the counterfactual distribution in the absence of a notch. The counterfactual distribution is estimated by fitting a polynomial equation and leaving out the area around the notch where the bunching occurs. This is our first result. We find that Thai firms respond strategically to the threshold. There is a sharp bunching just below the threshold, and the bunching estimate is around 2.4, which is within the range of estimate obtained in the literature. One possible explanation of such a strong response is the presence of non-VAT business. Small VAT registered firms might find it difficult to compete with non-VAT firms. They are similar in nature, but non-VAT firms can avoid charging VAT on their consumers. Also, in an environment with a large presence of non-VAT firms, there is less pressure to register yourself in the VAT in order to enjoy the tax benefit from trading with other VAT registered firms. We measure the presence of non-VAT firms in the local economy using the share of total sales of non-VAT firms to total sales of all firms with revenue not over 5 million baht. We construct this measure at the two-digit ISIC level across provinces. We refer to this ratio as the VAT informality. This is, of course, an imperfect proxy of informality, and we substantiate our choice by performing several sensitivity tests with respect to alternative specification of the VAT informality variable. This table shows the heterogeneity of the bunching with respect to for dimensions. We find that the bunching pattern is strongly correlated with the VAT informality variable. The bunching is much larger for firms in the environment with higher VAT informality. We also find that the bunching pattern is consistent with other factors discussed in the literature. This includes immediate input intensity, general competition level, and the share of B2C sales. We also examine the sensitivity of this with respect to alternative definitions of VAT informality. We modify the revenue level in the construction of VAT informality to 3 million and 10 million baht. We also reconstruct the VAT informality based on the number of firms instead of the total revenue. We also try using a lag value of VAT informality. All of the findings here indicate that the bunching estimate for firms in the high informality environment are consistently larger than those in the low informality environments. In addition to the mandatory registration decision, we also study the role of VAT informality on the registration decision that is voluntary. Similar to UK and many other countries, firms with revenue below the threshold could register voluntarily in the system. We find that the VAT informality has a large and significant association with how firms decide to voluntarily register for VAT. We also observe significant impact of immediate input intensity and competition, but their economic significance in the fifth column here are much smaller than that of the VAT informality. In the third section, we also look at the potential impact of the threshold on the growth of firms. In this figure, we group firms into 100,000 baht revenue bins around the threshold and calculate the persistent rate. This is divided as the probability that a firm remains in the same revenue bin from 1 year to the next. We find that the persistent rates here are noticeably larger for firms located in the bins just below the threshold. As a robustness test, we also divide firms based on whether the threshold is likely binding based on their propensity to register voluntarily in the system. The threshold is going to be more likely binding for those with the predicted probability lower than the median. We find that the pattern of the persistent rate that we just look at for the overall group is much more emphasized among firms on the left-hand side. That is the firms that the threshold is more, the VAT threshold is more likely binding. We also present another evidence suggesting that the threshold put the brake on the growth of firms. Here, we examine systematic difference in the growth rate between firms not registered for VAT and firms that are voluntarily registered. We focus on firms that are below the threshold. We choose these two groups of firms. We choose a voluntarily registered firm as a control group because the threshold is not binding for them. But these two groups are, of course, different in a number of ways, including reliance on intermediate input, competition, and as well as the VAT informality. We use the propensity score matching method to try to mitigate concerns about the comparability of these two groups. We find that firms not registered for VAT have a significantly lower growth rate than a propensity score match group of firms that voluntarily register. The estimate difference in the fourth column here is 3.5 percentage points, and these effects are stronger for firms that are approaching the threshold. So to conclude, our findings emphasize the effects of a VAT threshold on the growth of small business. It implies that setting a high threshold may lessen the negative impact on growth, since it keeps small firms free from the burden of accounting for VAT for a little longer. But raising the threshold will certainly enlarge the size of business outside the VAT. So our finding highlight that such rising informality is likely to distort competition, and it is going to impact the decision to register voluntarily and the bunching response. So this suggests that policymakers need to incorporate both the adverse impact on growth and the role of the VAT informality when they are deciding the threshold level. This is all of my talk. Thank you for your attention. I would be very grateful for any comment or suggestion that you may have. Thank you.
Sorry, I was trying to unmute myself, but I couldn't. Now I'm unmuted. There are a couple of questions in the chat box. One from Thiess saying, is a high excess mass at the threshold indicative of strong distortions or rather of easy manipulation of reported sales at the threshold?
Yes, that is a very good question. We don't have enough information to analyze whether it is real or misreporting a response, but we are trying to look further into that question.
Thank you. There's another one from Luca.
Yes, we try several different matching techniques, and they all yield consistent results. We have one table in the paper that shows this. Thank you.
Thank you. And another one from Mazhar. Can you see it?
Yes, we actually have results, the bunching from the personal income tax filer, but we haven't incorporated that in our paper yet. That is in one of that is on our to-do list. So in order to understand the VAT informality, we probably need to look at business that are not registered, those that are sole proprietorship, for example. So yes, thank you. Thank you for this question. We are definitely looking to explore and incorporate that PAT data into our analysis.
Thank you. You did mention, I hope I'm not mistaken, that competition decreases voluntary the incentive to voluntarily register. Did you say it was one of the results you derived?
Yes, actually, that is the results that have been well documented in the literature. The paper by Almunia last year also document this. So higher competition is likely discouraging firms from accounting for VAT.
Right. How do you capture competition in the data set?
yes, we use learner index. We follow Harmonious paper.
Okay, I see. Mazhar has a follow-up question. What % of firms in your data are voluntarily registered?
Around 40%, and that is surprisingly the same proportion as those reported in Harmonious UK paper.
Thank you. Any other questions from the audience? Please use the chat box. I don't see any more coming through. So thank you. Very interesting topic, very interesting presentation, and interesting results. No, thank you for joining us.
Thank you very much.
Thank you.